Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, January 6th, and this is the weekly market update. A few housekeeping issues just to remind you. First of all, Happy New Year. It's a brand new year. First video and podcast of 2024. We're back. Hope everybody has enjoyed their holidays and is charged up for a what I think is going to be volatile and exciting 2024. Having said that, let me just remind everyone, and I'm going to continue to pump this a little bit. I've moved pretty much my whole publishing business over to Substack. If you were getting the free emails, weekly emails I used to send out, if you were getting those in the past, I transferred all of that over to Substack. You've probably been seeing those new notifications or emails that a new email is out. Those are going to be a little bit more shorter and more data packed with links to stuff like chart of the week, maybe an interesting podcast that I've seen in the last week or listened to, and interesting articles that I've run into. And occasionally I'll write long form if something is materially changing, like we find a bottomed out industry or something of that nature. Maybe I'll write a little bit more, but most of the really good content will be reserved for the paying customers, and the ability to access the paid content is via Substack also going forward. Again, if you are a legacy subscriber, you are grandfathered in at the previous rates that you were subscribed at, and you will continue to receive the newsletter in the old style. It'll be emailed to you. It's just very difficult to have all these multiple payment tiers on Substack, or at least I haven't figured it out yet. So maybe we'll be able to figure that out and get everybody transferred over there, but it seems to be working well. People seem to be pleased with the transition. There are a few hiccups and bumps here and there, but we're going to continue on. Again, if you're interested in the weekly email, free emails, which have a lot of information, specifically around the themes that we talk about in these videos and podcasts, scroll down to the show notes here, and there's a link to that. You can sign up. In addition, you can just follow the link and read what we send out. You don't necessarily have to subscribe, but it'd be better if you did, obviously. And then again, if you're interested in the paid content and the portfolio that we have that tracks a lot of the themes we discuss, then that's obviously can be subscribed via the Substack tool. So just wanted to get that out of the way. Really seeing really good growth. I probably should have moved to Substack a while ago. It's making my life easier on the administrative side. As you all know, I'm kind of a one-man band here. And so I would like to focus more on content creation than dealing with administrative functions and subscriber problems, and people can't get payment things to work and things like this. So it's really lifted quite a bit of that burden. So again, everything is on Substack. If you want to go to the Substack, just search for Actionable Intelligence Alert and it will come up. So, or follow the links in the show notes. Okay, enough pumping of the newsletter. The disclaimer: anything that you hear or see on this podcast or video is not to be taken as investment advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, let's get into it. So from Jesse Felder again, I've always, just in the new year to say this, I've always advocated that you really have to be careful with the information you take in. Again, I really encourage people to read a lot of books, history books in particular, biographies, just general knowledge type things. And because I kind of agree, I fully agree with Charlie Munger. He said that he never really met a person that was successful or wise that didn't read all the time. So I agree with that. I have as a goal to go to sleep each night with more wisdom and knowledge than I had when I woke up. And so as compound interest works, or compounding returns increase your monetary wealth, increasing your knowledge, increasing your wisdom, setting aside time to think about things, developing a philosophical anchor. What do you actually believe in? These things are all cumulative in my view also. They compound also. And I think that if somebody would have better explained this to me when I was really young, it would have been a benefit to me. And so I'm fortunate that I was encouraged to read. I like to read. Not everybody does, but I think you should carve out some time and try to do that. I mean, I consume a lot of books. Amazon's very happy with my business, I'm quite sure. I read a lot in different subject areas, and I have different interests. And what you'll find is if you start reading, one interest will lead into another, and before you know it, that's kind of, to me, like meat and potatoes type knowledge building. A lot of people just spend a lot of time on Twitter or X or YouTube or TikTok, and that's more like eating Cheetos and ice cream. Yes, it's pleasurable. You get dopamine releases, you get comedy, you get whatever. You can have your biases confirmed, and we all have them, including myself. But it doesn't really do that much for you. Some of the stuff is really good on Twitter or X, some of the good channels on YouTube, but you have to remember that when you're listening to someone else's opinions, they have biases too. They have things that affect their thinking. And so you need to take that into consideration. So I think cultivating and curating a very good who you're following, basket of people that you follow on X is very important. And long story short, Jesse Felder comes out once a week with this email. He's prolific on Twitter. He does a good job. He really points out a lot of stuff that's timely. Doesn't necessarily add a lot of his own comments to his Twitter stuff, but the news feed is pretty good. The aggregation that he does, and he does very good. If you just go to his Twitter or X feed, whatever you want to call it, and you can sign up, I think, and get his weekly email. It comes out like Friday night. It's pretty good. You're going to get 3, 4, 5 items in there that are, pretty pertinent to what's going on currently in current events, vis-a-vis the economy and finance. So anyways, here's a tweet that he had, and here's our old friend Janet Yellen, goes on to say here, this is a quote, Treasury I think this is quoted from a newspaper article. Treasury Secretary Janet Yellen declared Friday the U.S. economy had achieved a long-sought soft landing, a historically unusual event in which high inflation is tamed without significantly damaging the labor market. Okay. The problem with this is that I think in the last 9 recessions, only 2 of them have been soft landings. And it's very possible that they have achieved this. But then again, the odds are against them. Okay. And Mrs. Yellen's, or Ms., or I don't know how I'll just say Secretary Yellen, her achievements haven't really been that impressive as far as I'm concerned. So her saying this, I guess, is kind of making my contrarian spidey senses tingle. But we will see, right? This is what's going to be interesting in 2024. The thing that I would point out here, though, for folks is that, I was listening to a podcast with David Rosenberg, an economist that I find very, well experienced, 40 years on Wall Street. That doesn't mean he's right all the time. That's one guy I follow that I enjoy. But what he pointed out in a recent interview, I think it was on Wealthion, was that, okay, so what are they telling you? If you have priced in a soft land, right now the market's basically priced in Goldilocks. Okay, not too whole. You've heard these terms before, and I think if you actually do a Google search, you'll find that Goldilocks is a very heavily searched term. So that's the consensus view, right? This kind of soft landing, no landing situation. But does that kind of lend itself to all these rate cuts that everybody's expecting? So some of the stuff that I think is being said or what the market's expecting doesn't jive with, some of these other terms. I mean, are you going to get 3 rate cuts this year if we're in a soft landing or no landing situation, or if we're in Goldilocks? Difficult to say. The only way you get a lot of rate cuts is if the economy, as David Rosenberg pointed out, the economy is in trouble. That's why they cut rates. And so again, my base case is more tending towards the hard landing. I think as the fiscal response, it's not going to peter out because a lot of money's still going into like these malinvestments in chip factories and all this stuff and this kind of nonsense. That doesn't trickle down as quickly and directly into the pockets of average people that have a propensity to spend. You know, that was the thing I think that a lot of people missed, including myself last year, and I pointed this out before, was, you know, just the direct payments from the government to people, and they just ran out and just went nuts buying stuff. And excuse me, one of the YouTube channels I find interesting is a used car guy, Lucky Lopez, showing all these cars that people bought on these binges and how they just destroyed them, never made payments on them. I mean, a lot of monkey business and shenanigans was going on. And just, but you know, that part of the fiscal stimulus is kind of drying up now, right? We're still building chip factories that probably will never run because somebody had, you know, Soviet style central planning. We're going to, you know, because China is now our arch enemy, we have, and they're going to take over Taiwan, then we have to build, you know, this multi-billion-dollar chip industry in the US, which is stupid. It's not going to happen. And so, yeah, there's money going into that, but, you know, that does filter down into, you know, construction worker pay and stuff like that, but it doesn't get there quickly. It's that Cantillon effect. Where does the cash go as it's flowing into the economy, right? As this is going into the economy, how does it go? How does it flow through? Who gets their hands on it first? Now, this is something that I want to explore more in 2024. And so getting back to this is, this person, I don't think anybody, maybe it would be a good research project for somebody to go back and look at all of their forecasts of Miss Yellen and what she said in the past and what her success rate has been. But, you know, this is kind of reminding me of George Bush standing on the aircraft carrier with the mission accomplished banner in the background in the first, or was it the second Iraqi war? And it was not mission, it wasn't over then. So these people make proclamations all the time because we're in a political season now, right? We are now, you know, basically 11 months away from a presidential election. And so the best spin is going to be put on everything going forward. And we'll talk about that more in the subsequent slides. So this is another guy, Peter Bookvar. He does the book report. I think you can subscribe for free. I got this, his take on the December payrolls that came out. And of course, everybody's excited because, you know, the economy now is doing well, right? Because employment is still doing well. But again, you have to look deeper into the data, and it's not all's well that everybody thinks it is. If you just look at the headline stuff on employment, you have to understand something. And something that was pointed out by some other folks on Twitter. Going back like 10 or 12 months now, we have these reports that come out from the government on employment because they want to make employment look good, right? Obviously, with an election year, and Bidenomics is a success and all that jazz, right? But the problem is that once the headline goes away and the market's digested that, because most people aren't diving deep into the data, then the government will come in subsequent months and revise the previous data downwards. And that's, wasn't able to get the chart. I had it, but I've lost it, or I don't know, misplaced it. But it was somebody went back and did that work, and there was like, I think out of the last 12 months, there was 11 revisions downward and only one revision upward. So so what's really going on here? You know, am I accusing the government malfeasance? No, this is a lot of data, and they're constantly revising data, even a year later sometimes or more. The problem is the market has a view, and it's so overpriced, price for perfection, if you will, then what happens when reality does eventually, you know, collide with the fantasy? And so anyways, this is Peter Bookvar's, another guy that I follow on Twitter, or get his, hear him in various podcasts. He says December payrolls rose more than expected, but the longer-term trends continue to weaken. It says here, most of December's job gains were concentrated in three sectors: government, private education and health, and leisure hospitality. The total number of jobs added between these sectors amounted to 166,000 of the 216,000 total. The job gains in government and private education health are obviously very non-cyclical. And I will say this, a job is a job, right? It puts money in people's pocket, and most of the people that work for a wage have a very high propensity to spend. And so this is what's been holding up the economy, right? It doesn't matter. A lot of people say, well, the government jobs don't matter. These jobs, it matters, okay? People get paid. The job, I don't think it's sustainable for the government to be adding all these jobs continuously going forward, but we'll see. I think when you deep dive the data, though, it becomes a little bit more alarming. It says here, a large drop in the labor force kept the unemployment rate at 3.7. Okay. The reduction in average weekly hours worked points to lower labor demand as well as employers' reluctance to shed hard-to-find workers. So average weekly hours worked is going down. It has been going down. Then it goes on here to say, we saw more involuntary part-time work in individuals holding multiple jobs, which points to underlying weakness. Not only that, see, this is the problem. The headline numbers don't really tell you what's really going on in people's lives. If you're working 2 jobs, 16 hours a day or 12 hours a day or whatever you're doing, and the jobs are probably 2 crappy jobs combining to just barely keep your head above water, an economist at in DC will think that that's, well, that's good, right? That's a math thing. They just add it all up and average and median and all that. But if you're actually doing that, working, some service job for 8 hours a day and then driving Uber for 4 to 6 hours a day or delivering pizzas, or whatever you're doing, or having 2 retail jobs, your life sucks. You're having a hard time making ends meet with the 20% rise in prices over the last couple of years. And you're not happy, okay? Even though an economist at the Fed or in DC will say, well, look at all these jobs, look at all this income. So that's my point. It goes on here to say, job growth is increasingly concentrated in the government and healthcare sectors. Private sector job growth is slowing but remains positive. We saw that also in the ISM service PMI index that came out, where the employment part of that, if you go deeper into the data and past the headline, is well below 50 and contracting. It's if you go to the ISM page and look it up, you'll see that. So government can't increase jobs forever, otherwise we'd be 100% government work in a command economy. It's just not going to happen like that. So then it says unemployment rate held steady at 3.7% and wages were up 4.1% year over year. This is actually pretty good, as people are, I think, slightly ahead of inflation now. So what I've said before, I think, is still in effect. You have different pockets of the economy. Construction's doing well. Some service sectors are doing well. If you're a pipe welder, specialized welder, you can get a job. There's certain job classifications that are in high demand that cannot be fulfilled even in a recession. There's just not enough trained people. And so I think, but looking at the overall picture, I mean, manufacturing's been in a recession for a year at least. Okay. So, manufacturing's only, I know, what, 12%, 13% of the economy. So I think things aren't as rosy if you dig down deeper into the data. And so we'll see how 2024 plays out. I mean, rates are still high. The effect of those higher rates is going to play through. Some people are saying, well, the economy has demonstrated that it's able to absorb these rates. We'll see. And, remember that QT is still going on. And, the Fed is shrinking its balance sheet. So again, we'll just have to see what happens over time. My view is that, this is a lot of mixed data, and you can point at data, you can do war of the data selection, right? cherry picking things for either camp. But it's not definitively in recession, but not definitively booming. And I don't know where the growth comes from. If your idea is, well, fiscal spending on malinvestment, yes, that will make the GDP go up. But is that good long term? I don't know. Are we really going to move a chip industry from Asia to here and it's going to be successful because the government gave a bunch of money out? No, people will take the money and try to build the things and try to do it. But, that's not how a real economy works. That's how a Soviet style economy works. The Politburo decided in the 5-year plan we were going to have a chip industry, and then it doesn't matter what the costs are, we're going to make it happen. Well, we don't have the resources here. You can build a factory, you can put the cement floor down, you can put the building up, but you can't get the people to operate it, and that because the knowledge isn't here. We don't make things here. Okay, all that left our country decades ago, and that's why a place like Taiwan specializes in that. This is macroeconomics 101, right? Comparative advantages. But we've decided, because we want to have a war with China in 2025, that we have to bring the chip industry here, because if we start a war with them, the country will collapse because all the chips come from Asia. Again, we'll just have to watch the data as it comes in. There's a lot of challenges, which I'll get into further to this Goldilocks narrative. So we talked about hours worked. Here's from the Economic Cycle Research Institute. It's not just in the last month or so, it's been in decline. And if you look at previous recessions, okay, we're starting to get into areas where, it's obviously hours worked boomed after the pandemic because of the supply chain rationalizing, right? We were so far behind, we had shut the economy down. So everybody was producing and trying to get their orders filled. And so we had this big spike, but now that's worn off. Okay. And now we're into decline. Even before the so-called COVID pandemic, we were heading for a recession then, until all that fiscal stimulus and the Fed coming in and printing all that money, which is what you see here. And then as that stuff, it's like any kind of rocket ship. It goes straight up, but it doesn't go straight up forever. It runs out of that fuel, right? They raised rates. They instituted QT. The fiscal inputs into the economy from the government petered out over time. The forbearance payments on rent and college tuition, all that stuff's gone away. And so that's now exerting gravity on some of these numbers. That's my point. Individually, not one of those things is going to cause it, but collectively, does that create enough gravity to pull the economy into a recession that it was heading into anyways before the pandemic? So we'll see. This is from David Rosenberg. ISM Manufacturing share of industries reporting growth. So you're basically down to like 5% or close to zero. You're at areas where in the past has been recessions, right? Where the ISM Manufacturing share of, the share of manufacturing industries reporting growth is almost zero. That's not positive. But again, manufacturing is only 12 to 13% of the economy. So you have to take it into context. I thought this was an excellent point that Lynn Alden made here. And this is something that's kind of like a soapbox thing for me. As you study, if you understand how central banking works, if you understand the racket that they've created where they can create money out of thin air, quantitative easing, all this crap that they pulled during the pandemic, just giving free money away, you understand that over time, inflation is biased to go upwards. That's what they say, the 2% target. In a real market economy where you don't have this kind of central planning going on with interest rates and a central bank that has the ability just to create money out of thin air, you will have a tendency towards disinflation, right, over time as products get better and cheaper and productivity raises workers' wages. You will have a slight disinflationary bias, which makes people wealthier over time. But because we have central banking, because we have all this nonsense, again, I want to explore this more in 2024, the Cantillon effect. When a central bank cuts rates and prints money, how does that money make it into stocks and assets and things like that? Because contrary to what everybody says, yes, we don't necessarily have price inflation when the central bank prints money, okay, the way they have done in the past, but we have had asset price inflation. That's why we have, these huge bubbles in these various assets. And so I think what Lynn Alden's pointing out here is that when you have let's read what the tweet is. A challenge for Team Transitory on the topic of inflation is that unless inflation runs well below the Fed's target for a while, prices won't be returning to their prior trend. Exactly. So they say, well, our price target's 2% or 3%, what have you. So if you extrapolate that over time, you're losing purchasing power. They're stealing wealth from you. When they devalue the currency slowly over time, they're stealing your labor. They're stealing your time. They're stealing your life energy. It's that simple. People say, well, they'll get up there and like the devil say stuff that you say, well, the inflation rate came, Karine, whatever that moron they have as the press secretary, and the rest of these people in the administration, they'll get up there and say things like, well, the inflation rate came from 9% down to, 3%. Isn't that wonderful? Yeah, but the cumulative effect is you've lost 20% of your purchasing power over the last couple years based on what they did. And all of the money they printed, yeah, it went in your pocket, okay? And you paid more for the goods because they shut the economy down. And in the meantime, Wall Street, who stands right there with their mouth open at the printing press, gets first dibs on the money and runs into the asset markets and bids up assets because they get the first crack at the money. And so unless prices run below trend for a while, which you see that there's no incentive to do that, that's not good for asset prices. That's why there's a constant low grade fever of inflation. Well, our target is 2%. Well, what does that mean in a person's lifetime for 5 years, 10 years, 25 years? They are literally stealing. The currency loses its ability to store value. Okay, that's what you're doing. You create a surplus, okay, of value in whatever you're doing with your labor or exchanging your labor, your time for money, creating a business, what have you, trading, whatever you're doing, and then you have to have a store of value, right? Because you're creating this surplus, like a squirrel, puts nuts up for the winter. You're doing the same thing. But if you have a central bank perpetrating a fraud via basically printing money out of thin air, they're creating more currency units, then they're devaluing your existing store of savings. And you lose purchasing power over time. They're stealing your time. They're stealing your life. You're literally enslaved to the central banks and to Wall Street. I mean, that's really how simple it is. And people scoff and stuff like that. Okay, put a 2% inflation rate into a compounding calculator and tell me over your lifetime how much purchasing power you're going to lose just a 2% inflation rate, which is basically what their goal is. Again, the best thing for the average person is to have a slight disinflation where prices go down over time, lower over time, based on what? Based on productivity gains, and based on better products, higher volumes, cheaper products that are better, that benefits the average person. So what we have created a system here, okay, that benefits the few. And so the prices, yeah, selectively they'll go down here and there, but overall the trend is always going to be higher. And then you had this extreme thing that should have woke people up, but it didn't. They still don't understand inflation. They don't understand central banking. They don't understand how currency it comes into existence. They understand none of this. And that's done deliberately because if you actually understood that you're enslaved to these people, then I think there'd be a great uprising. Many people have said that, but again, that's not taught. This isn't taught anywhere. Okay, they don't even teach you how to balance a checkbook. I mean, they don't want you to be literate in these things. They want you to, as Otto von Bismarck said about public education, it's not to educate people, it's to create citizens to serve the Prussian state. That's what the purpose of public education is. Of course, I'm veering offline. I'm veering off into other tangents now, but I think this is excellent. Most people, I think, don't understand this. And again, it happens at such a small rate. It's again the boiling frog syndrome. You don't feel it in any one year. Now, we did feel it in the last couple of years, okay? And I guarantee if you people in Argentina and Turkey, where they have 100% inflation a year, feel it, and you get impoverished over time. You see it, okay? And in those cases, many times they don't understand it. I thought this was an interesting chart just to bring to your attention. Why? Record flows, ETFs drew a record 135 billion in inflows in December. Well, this might have had something to do with, juicing the stock market at the end of the year, the so-called Santa rally, right? The end of the year rally that we saw that went into basically the concentrated, if all this money's flowing into S&P 500 funds, it's going to go to the highest market cap stocks, which are your Mag 7 stocks. We'll see if this continues. Again, all these companies are overvalued. Everybody knows that. You saw what happened to Apple in the last week. I mean, some of these companies aren't really even growing that relative to whether the expectations that have been priced into them. It's just a matter of money flows, which is fine. Again, we've talked about this before. I'm not opposed to liquidity and sentiment drive markets in the short and medium term, but again, I don't buy overvaluation. I saw somebody, this got pointed out, and I think it was in the Twitter feed. Somebody said, so the best thing to do is just buy the Mag 7. Why? Okay, buy the Mag 7 at, I'm not going to argue with people. I have a methodology. I don't buy overvalued securities. I try not to. Those are not investments. If you're buying these things at these levels, you're speculating. And that's fine too, as long as you understand what you're doing. Okay. And you understand historically when you buy things at 10, 20, 30 times, 40 times sales, what have you, these extraordinary valuations, the tendency is that your returns over the longer term will be low to negative. It's just how it is. So I find it interesting. I don't think inflation, I think we could get surprises to inflation. Why? Supply chain issues again. Why? Well, you already had the Panama Canal was having lower transits or longer transit times with less ships. Why? Because of the drought that's going on there and the inability to have normal transit through the canal. Some ships deciding to go around South America, extending their trips basically. And now this situation in the Red Sea, i.e. also the Suez Canal with the Houthi rebels in Yemen basically launching missiles and disrupting shipping through the Red Sea and Suez Canal, causing many shipping companies, like most shipping companies, I think now in the West at least, to forego going through there and putting at risk their ships and going around the Horn of or the bottom of Africa and then going to Europe, which is extending the times for transit by weeks. So obviously, if you have longer transit times, you have more ton miles. The supply of ships hasn't magically increased. Therefore, you see what has happened. Rates go up. Shipping rates per container are up 61% just in a week. And I think that's starting to filter through now. And so, as I called it before, it's like, okay, we'll have to watch this and see what goes on if this dissipates over time, or if the United States and the Western powers seem to be not able to get their act together to have a military intervention. I think there's a worry that starting to mess around with these people, again, this is a direct result of the United States tying itself to Israel. I'm not going to have that debate. You can tell me about, they're our ally and all that stuff. That's fine. Understand that there are consequences to that. And this is one of them. Okay. I'm not saying that we should support them or not support them. I'm not going to get into that discussion. It's irrelevant to this discussion. What we see is the fallout of the policy, which is the disruption of shipping traffic. And so what does that mean? Well, these costs are going to be passed on to consumers. Maybe at first people will eat the cost, but over time. And the same thing's happening with oil. Okay, longer transit times. And the same thing's happening with product tankers. We're seeing rates going up across all of shipping because of these two things that are happening. Okay, and again, the ability, you can't just flip a switch and create a bunch of ships to accommodate this, these longer trips. But the same amount of cargo has to be carried or more over time as the world economy grows. And then you have to travel longer distances. Therefore, you're going to need, rates are going to go up. So this is something to watch also. The shipping stocks that we have in the portfolio have responded very nicely. This wasn't the reason that I bought them. I've had them for some time, but these things are cash flow monsters, as the thesis being specifically to tankers and product tankers that there just hasn't been enough building of new tankers to accommodate the shipping. Now, shipping is tremendously volatile anyways, but I think the companies that we have, they're cash flowing very nicely. The dividends are there, the buybacks are there, debt repayment has happened in many cases, and I think we're still, we haven't seen a real tanker bull market yet, but I think that's coming. This helps exacerbate that, right? This brings attention to these industries. And again, these costs are going to be, I think somebody estimated, just like for crude oil, going around Africa from, Saudi to wherever, or the Middle East to Europe or something, it adds like $3 a barrel to the cost of the oil being transported. So that's going to be passed on to somebody, the consumer, typically. So this is from US Global Investors' recent email out. I just wanted to show this because I found it interesting. This is the 2023 returns by asset class. Of course, I'm not going to have every asset class. This is, a lot of good stuff on here. But again, a lot of people missed the boat on Bitcoin. I had talked about it. I didn't go full hog into it in the newsletter. In my personal account, I did buy a couple companies. I have loaded up on another company that I've been following. But I'm following the financials of these companies, and these higher prices around 43, 44,000, whatever, really have changed the financial metrics of a lot of the companies. So they're doing well. Obviously, the NASDAQ 100 has done well. We all know that. S&P 500 was up 24.23%. I would point out that the Actionable Intelligence Alert newsletter was 24.24%, give or take. It's not dead accurate because I don't account for interest on cash being held and all that stuff. So, I mean, just tentatively, what my portfolio, the Actionable Intelligence Alert portfolio basically beat the S&P 500 by 0.01%, which I found humorous. Again, emerging markets. I think this is going to be they were up last year. I think it's going to be a tremendous year this year for emerging markets, and the next couple of years. I think that we have turned the corner there. I find it interesting. I talk to a lot of people. I read a lot, and everybody, is still poo-pooing emerging markets. But I think, they do go in cyclical, secular type trends, and they have a tendency, if the U.S. is doing well, they underperform. However, they have a tendency when the U.S. is underperforming to outperform the U.S. And I think we're getting ready to enter one of those situations. Here's developed markets ex-US. Gold was up 13%. I think it's been up now 3 years in a row. Again, it's doing its job. I think this is going to be another tremendous area of higher returns this year. I think that we'll get into that a little bit later. Central banks have definitely reversed their rate raising trend since August. Last month in December, I got the final numbers in. It was the biggest month of cuts versus raises that I've seen in the last year. So the trend is definitely accelerating with more and more central banks around the world cutting rates. And so expect a new liquidity cycle. This is what I was saying for all of last year. Now, it takes time. There's a lag effect on that too. But I think the trend is going to be very positive for liquidity cycle. As a matter of fact, China is going nuts recently, adding liquidity. We'll talk about that in a little bit. But you see down here, one of the underperformers was commodities. I think that reverses. And I also think that maybe crude oil reverses again as a consequence of the money printing, the new liquidity cycle. Economies will reaccelerate around the world, and we will have a, this is have it. These things have a tendency to benefit. Now, obviously, the U.S. dollar was down 2.1% last year. I think that that's going to be a little bit. It's going to be down even more this year because if, in fact, we do get into a hard landing and the Fed cuts rates, that's going to lower the interest rate differential, the positive differential that the U.S. has enjoyed, which has caused capital to flow into the U.S. dollar. I think that will have if we in fact get the amount of rate cuts that I'm thinking this year, the dollar would have a tendency to weaken versus other currencies as the positive interest rate differential shrinks, particularly with the euro. I wanted to point this out for a couple of reasons. Sometimes people put these charts up and they're like, okay, what's your point? This is very interesting, but what does it mean? And it says here, Mag 7 market caps larger than the equity. So the total market cap of the Magnificent Seven, which you see listed on the left, Tesla, Meta, Nvidia, Amazon, Google, Microsoft, and Apple. The market cap of those Magnificent Seven companies is larger in total than the entire market caps of the countries of Japan, Canada, and UK. And somebody will say, okay, what's your point? My point is this. I think there's a definitive opportunity, a really great opportunity in Japan. I've been looking at it a little bit. I've looked at it for several years and it's had several false starts. There was a recent paper out from GMO that kind of pointed out, and some other folks too that I follow on Twitter that are in the Japanese market. There are major secular fundamental changes that are now happening in Japan, similar to what had happened in the US maybe 40 years ago, to unlock and help get Japanese companies to be more shareholder friendly, to realize the underlying value inside the companies, the latent value. There's so many companies in Japan that trade at, 30 to 40% of book value. There's a lot of companies with land assets that aren't fully valued. There's just a tremendous opportunity. And so there's a push in Japan, and I'll put a link to the article, the GMO article. It's worth listening to. I'm going to be expanding upon this in the Actionable Intelligence Alert newsletter, probably in the next month or so, because I think there's an opportunity there. Obviously, it's harder to get information, but Google Translate works. I mean, this is how I read a lot of foreign, annual reports and quarterly reports. You put the PDF in there, it will translate. It's not exactly, but you get the point. And so what you're starting to see now from Japan is pressure by the Tokyo Stock Exchange, the Ministry of Finance, pushing these people. There's this cultural situation in Japan around, not taking over other companies as far as hostile takeovers to realize value. There's no Carl Icahn in Japan that I know of. But that's going to change, I think. And I think that, there's a lot of companies that are there's companies like I bought a couple of companies this week, just small starter positions that basically were smaller steel companies. They don't really manufacture, distribute, and kind of do metal processing, but they're owned. Each of them is owned like one of them is owned like 30% by Nippon Steel, and then Nippon Steel owns like 25% of the other one. The goal of the Ministry of Finance is to get these kind of situations cleaned up. It's like, okay, and these things are trading at like less than half of book value. They typically make money every year with they're not super growth businesses. It's not Nvidia. It's not, sexy. But what it is I think a trend in change in thinking and behavior. And if you read the GMO report also, it's going to kind of a good primer on what I'm talking about. It's a situation where I think there's a tremendous amount of value in Japan. Yes, somebody's going to come back and say, well, Japan has all these issues. It's a stagnant economy. They have all this debt. They have demographic decline. That's all understood. But they have also doing things, like I said, the Ministry of Finance and Tokyo Stock Exchange and other regulators there to get people, to get these corporate entities to be more shareholder friendly and to clean up a lot of this lower valuations. In addition, I believe, I can't quote it directly, but basically they're making changes to their, they don't have, like, it's not called a 401k, but something similar in Japan, where they're going to incentivize people to, take money out of lower interest bearing securities and get it into these markets. And that could be several trillions of dollars worth of yen going into. So I'll put a link to the article. The reason I really wanted to point this out was to show you that, Japan's like the third largest economy in the world, something like that. And it's tremendously undervalued, and nobody cares about it. No, everybody hates it. The other thing I would point out is that there's reasons why Japan didn't do well. I mean, went through a 40-year bear market. I was in Japan. I lived in Japan for 3 years in the early 80s when I was very young, not a kid, but I was like in the service. I spent 3 years there, and it was the boom times. It was the end of the boom, and it was a tremendous time, I remember. And I haven't been back to Japan since, but I do know that after that tremendous, basically, boom, where they were out here buying all these crazy assets in the US, and one piece of Tokyo real estate was worth more than, or crazy metrics, like one small parcel of Tokyo downtown real estate was worth more than like all of Los Angeles, or some crazy metrics like that. I can't remember exactly, but there's off the wall metrics. And so that it took years to unwind that, right? And so I think that a lot of things are changing now. Again, it could be another false start. Who knows? Maybe all of the other negatives that I talked about are going to overwhelm these regulatory and ministry government changes that they want to see happen. But I do think it's an opportunity because it's so undervalued of a market. The other thing, it's very opaque because people don't read or kanji or speak Japanese. They don't understand the culture fully, and so they're going to be shy to do that. But I think that if you get down into the weeds of some of these companies, and you can run screens and stuff, and there's plenty of people on Substack that are, I guarantee you, are fully, engrossed in, Japanese companies. You can get the Japanese company handbook, what's listed all as the companies. It's in English, and go through it. It comes out like, I think 4 times a year, twice a year. I used to get it. But again, I will admit there's been false starts, but I think there's something happening here now. So it's worth looking at. And again, I sell overvaluation, and if all of these 7 companies here in the US, and, I'm not blackguarding these companies are all good companies, have good products, but are they worth more than the entire, these 3 countries' market caps? You're talking about the entire country's market caps. And so in Japan in particular, I think there's an opportunity here. So I wanted to point this out. Again, if you recall, Goring and Rosenzweig have been writing about this for a while. Basically, the Permian basically did all the heavy lifting for oil supply, the oil supply that basically, has carried the world, if you will, and been a big boom for the U.S. to be a, leader in energy production. But what if the Permian now, as Goring and Rosenzweig has said, they thought that they were near the peak, and that I think it was a couple quarters ago they wrote maybe it was even a year ago, I can't remember, but need to go find that paper and reread it, where they did the analysis with AI analysis, and went through all the data, and it was looking like, the Permian was going to peak and go into slow decline. It doesn't mean it's going to disappear. The Eagle Ford and Bakken haven't disappeared, but eventually all oil fields reach a peak, plateau, and then go into irreversible decline. And so the view was that what happens when the Permian eventually stops growing plateaus and then eventually goes into decline. Well, what happens to oil prices? How does that affect the oil market around the world? Well, I would suggest to you that when you have 1 to 1.5% demand growth a year, which has been pretty much stable throughout the last several decades, when you have all these emerging markets and frontier markets demanding more oil, when you have, Exxon talking about what they said in a presentation a couple of years ago, where they were calculating into their thought process 6 to 7% decline rate worldwide, then you need to, you add that with new demand, and you're at 100 million barrels a day. You're talking 6 to 7 to 8 million barrels of new production, and that you have to find and replace every year because of depletion and demand growth. And now when you have the Permian, which has been a success story beyond anybody's wildest dreams, but it's not an ever never ending cornucopia of oil. It's just not how things work. Okay. And so I think that analysis that like Gordon and Rosenzweig did, and others are not the only ones, where they said that, things were going to eventually peak and plateau. And when they did, that was going to be material to the world oil market. And I think, at least, there was a lot of discussion on Twitter about this week. And I think it's worth taking a look at. That doesn't mean we're going to run out of oil or anything like that. What it means is, again, a lot of the focus was on the Permian. The Permian sucked so much oxygen out of the room, or U.S. oil production, when it was went from 5 million barrels a day of production to 13 million barrels. That was an 8 million barrel increase over the last 10 years, what have you, give or take. And it wasn't going to go on forever. I mean, there was again, I've said this before, there's crazy stories when this shale boom was going on about U.S. is going to go to 25 million barrels a day of production. We're going to take over the world oil. It's going to go on forever, blah, 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 never ending. That's not how it works. And so if we are in fact seeing if we're seeing a plateau in the Permian, it's worth keeping an eye on. I make no forecasts. I'm not a geologist, but I do know that in my mind, there has been a lack of investment around the world for all the reasons we've talked about over the years. And I think that, when the Permian finally gave up the ghost and can no longer grow, that's going to put pressure on a lot of other areas around the world to get with the program. And so, yes, there's constantly projects being developed, and there's constantly new production coming online. But there isn't another Permian in the U.S. as far as I know of. Maybe somebody knows, but I'm not aware of any other basin that's going to be able to take the baton now and go on this massive growth spree to, take up the slack for these three basins that are looking like they might be going into decline. And so it's worth watching because I think it will be impactful and material over time to the oil market. And again, oil prices never really crashed, right? The U.S. hasn't really entered its recession yet. Europe's in a recession. But, with all the central bank liquidity operations happening now around the world, and more central banks cutting rates, and economies poised to reaccelerate over the year and into 2025, that's going to require more oil, not less. So we have a lot of things starting to come together, I think, that are pushing us to what I've always forecasted as a possibility, maybe later this year, maybe early 2025, where we do get that higher oil price just because of demand running into supply issues. So I'm not forecasting anything. Again, it's very difficult, but I do think that this is another reason why I'm so bullish on offshore oil services. Offshore is the growth area. That's where the growth is going to come from. It's has a lot of potential. Again, the industry is so atrophied. I told the story. I mean, if you're in a body cast, I broke my arm in an arm wrestling contest in Alaska when I was in the service. It was a sanctioned event. It wasn't just some barroom brawl, but I snapped my arm, and then I had it in a cast for like months after they had to put a plate on my humerus or that upper bone. Is that a humerus, I think? And when they took the cast off, I mean, it looked like a concentration camp victim's arm. It took a lot of, I mean, I couldn't even straighten my arm. The tendons were, it was a lot of rehab. And so that's kind of what's happened to the oil industry, right? It's atrophied, and it's going to take a long period of higher prices if it ever recovers. There's people in the industry saying you'll never build another, big drill ship or one of these, if you do, it's going to cost you $1 billion. We're nowhere near that, but yet demand is increasing for these services, for this equipment, because as these areas like the Permian go in decline, the pressure is going to be to ramp up Guyana or West Africa or all these, there's a tremendous drilling boom happening just in the Persian Gulf by Qatar, Saudi, and these other countries, because there's a lot of offshore oil and gas there. And we have a company in the portfolio that's taking advantage of that very well. Thank you very much. But that's where I think a lot of this other stuff's going to come, and we haven't seen that the investment that's going to come into those areas is going to lead to higher rates for boats, rigs, services, what have you. And so I think that's a multi-year opportunity still. So again, you can see it's happening. I was talking about this in 2023. We caught the bottom of this. This is going to be accelerating over time. This is a monthly number of global central bank rate cuts, 3-month cumulative. This is from Bank of America, but you see the trend is moving higher, right? And again, as I pointed out, December had the most rate cuts in the last year vis-a-vis rate increases. So this trend will continue, and you will see. I don't know how high it will go. I mean, the trend is what I'm more concerned with, right? And we definitely have turned people have declared victory on inflation in many of these other central banks and are now cutting rates and increasing liquidity. And typically, liquidity, as you know, leads markets in the short term. So this was pointed out by Callum Thomas, is a guy I follow again on top-down charts on Substack. This was, I think, his chart of the week. Interesting. He says policy rates, U.S. strain from the pack. So you had, this is developed markets ex-U.S. policy rates for rates. Here's the U.S. We were raising rates before everybody else. That created a big differential that caused a lot of capital to flow into the U.S. to take advantage of those higher treasury rates vis-a-vis the other developed markets and put upward pressure on the dollar. I would suggest to you, we don't know for sure, but if the U.S. is going to lead in rate cuts before the rest of the developed markets, then we could see a situation where this starts to compress and the U.S. dollar comes under pressure. That again would be wind in the sails of the commodities and emerging market stocks. So we'll see, but remains to be seen. We've seen this in the past. Where the U.S. has led in raising and then cutting. So we'll see if it returns to form here. So I want to talk about China. China Central Bank adds $600 billion of yuan equivalent reserves to its balance sheet in the last 4 months. This is the largest 4-month change in the China's balance sheet in I think it's history. This is from Tavi Costa, Crescat Capital. I think this is important, right? I have not took a position, but if you take a look at Chinese stocks, if you take a look at stocks in Hong Kong, there's opportunity there, I think. And again, if they're going a liquidity, the sentiment is horrible. Everybody hates China. Everybody, the West is totally against China. I get it. So the sentiment is zero, is like nobody's advocating buying China. The only person that seems to be positive on China that I have seen is GavCal, Louis Gav from GavCal Research. He's talked positively about this and exactly why this would happen. Now, again, we thought that this kind of balance sheet, I thought this type of balance sheet expansion would happen after COVID last year and really get the Chinese economy ramped up. And in fact, they did do that, but not to the extent that I thought. And I think, things are weak there. There are issues. I mean, no one can really know what's going on in China. It's kind of difficult. But when I have somebody that's, writing about this and talking about this, that's lived there and is kind of an outlier, it makes my contrarian spidey senses tingle. Everybody hates it. The liquidity is increasing. It's something to watch, at least, right? Uh, maybe finding some ETFs or some other situations and waiting for a breakout and maybe looking at it as a trade. Again, when I talk about Japan or China, people are going to come back in the comments. It sucks. It has all these problems. Yes, but one of the best performing stock markets last year was Turkey. Okay. And it has a bunch of problems. Again, a lot of things are driven by liquidity and sentiment reversing and mean reversion. And I'm not saying that, you should put all of your money into these places. Pakistan was another place that's in turmoil, but its stock market has done fairly well recently. Egypt is another one to look at. So there are opportunities, I think, if you're willing to, watch some of these things. And then when you see this kind of central bank, balance sheet expansion, again, this has a tendency to flow into the real economy, flow into the markets, and could create some potential opportunity over this year. I think I saw one person say, and I think it's a possibility, that China will be the best performing market this year, and it probably will surprise a bunch of people if it happens. It's the same thing, these things are under the radar, and it just becomes obvious in retrospect, why it happened. And so I think I'm not advocating go out and buying these things, but it's definitely on my radar screen. And it's definitely probably could be worth a smaller position, and then watch it. I think I would approach it more in a general context, not just buy one company, but there's some big companies there that are doing well and are, maybe just think about buying an ETF. I don't know. I haven't decided yet, but I think this is worth taking a look at and watching. And here it is. This is from GavCal Research. If you go back and read, he had a recent article. I put a link to it in the free email last week, which you can take a look at Substack. There was an article from GavCal talking about a lot of what's going on in China that people are missing. So it's worth taking a look at. So wanted to point this out as far as tankers. One of the characteristics, one of the reasons why I'm bullish on tankers is the supply demand situation, right? Supply and demand in these commodity markets. And, there's no really like proprietary knowledge to running a tanker business. It's like you go to a Korean or Chinese or Japanese shipyard, you order the thing, they, you negotiate the price, they give it to you, you put it out on the ocean, and there's plenty of companies that will manage it for you, and you just collect the money, right? And typically, these things are, this tanker market's very volatile. But one of the things, it's been a very big boom and bust type situation. But one of the things that drew me to it over time is the lack of new builds, right? The tanker fleet is exceptionally old relative to its history. I've shown the charts before, and they haven't really been building a lot of tankers because the business hasn't been doing that well. And so the supply of tankers coming on has not been a big, what you've seen in the past, right? When tanker rates go up, people, build a bunch of tankers, and then that crashes the price, and then they stop building them and rinse and repeat. But you see here over the last, the average has been about 39 new very large crude carriers delivered per year. Okay. And so these are the deliveries going back to 2000. It's averaged about 39 per year. What's interesting is you see, like in 2023, there were only like about 20, and in 2024, there's only one very large crude carrier scheduled to be delivered. And then you see 2025, 26, and 27, there's just not a lot of, this is like totally an outlier from what we've seen in the past. And so I think that, as economies recover, as we go through, oil demand will continue to increase. It'll require longer voyages because where the oil is going to have to come from to where it has to go to be consumed, I think is going to put pressure on, additional ton miles. And again, that's what leads to a tanker boom. So we're seeing something similar in various other sectors of shipping. We saw it in container ships during COVID, and what happened? They did exactly what they do. They had a big boom in container shipping rates, and all these companies went and put all these orders in for container ships. And so you're having this big glut now of container ships coming out of the market. So much to the fact that if you try to order any other ships right now, it's difficult because the yards have all these orders for these container ships. And so I think eventually the same thing will happen with these tankers, but we have to see the boom first. Even in the interim, while we're waiting for this boom to happen, the returns have been fairly decent. The companies that I have really reduced their debt. They're paying nice dividends, and and buying back shares, either and or. So they're either doing both or one or the other, what have you, but you're getting these returns back to shareholders as you wait for a boom cycle, which I think is going to happen. And this really tells me, because I mean, look at this, is such an outlier to what you've seen in the past. So we'll see. I think this is a result of several factors, but I don't see, I don't have data beyond this, but this is sufficient, I think, to create a boom, especially as we recover the economies around the world as we go into this new liquidity cycle. Wanted to point this out. Copper prices headed higher on supply. We've talked about it. People like Robert Friedland have talked about it. I think people thought that 2024 would be a slightly surplus year. Now it's looking like, with the situation that happened in Panama and some other situations, that the copper supply is going to be in deficit sooner than people thought, and to a greater extent. And so that means higher prices, right? It says copper is headed for a price spurt over the next 2 years as mining supply disruptions coincide with higher demand for the metal. Rising demand driven by the green energy transition and a decline in the U.S. dollar strength come the second half of 2024 will fuel support for copper prices. Well, we'll see about that. I think that's just a matter of supply and demand. The supply won't be sufficient to meet the demand for various reasons, and you're going to get a higher. It's amazing that copper is still, with all of the economic issues around the world, is still like 380, 385, 390 a pound. So I think, the next trip higher, where does it go? 5, 6, 7, 8. Goring and Rosenzweig have said that they can see $10 copper sometime this decade. So I think a lot of these commodities are going to make new all-time inflation-adjusted highs. And I think that the super cycle that we're looking at is not necessarily going to be like the last one that was driven by China entering, basically having its coming out party and entering the WTO back in the aughts, right? Like 2003, 4, 5, 6, around that time. China was just basically vacuuming up everything as it really went whole hog, in its economy growing. So I think that emerging market demand, obviously energy transition demand, but really I think what's going to drive things is going to be the lack of supply, because we've pointed out on multiple occasions from multiple data sets the tremendous amount of underinvestment that has happened in all real assets. And I think that's going to be the driver for the commodity super cycle or upcycle, whatever you want to call it, that we're going to see for the rest of this decade. Okay, guys, that's it for this week. Again, I want to remind you, please follow me on Substack. I'm on Twitter. Avail yourself of the free email. You don't have to pay for the free email on Substack. We do have a paid option, but you can get a flavor of what we're offering. I think we give a lot of good information, even on the free emails that are weekly. We don't spam you. You get basically one email a week, and occasionally I'll put out something else when something happens that's relevant. But I think it's a good value, and we're slowly growing this forum. And again, appreciate the support, appreciate growing the channel here on YouTube, and like, subscribe, and help us out that way. That's the best way you can help me out, is by liking the videos, commenting in the videos, and sharing the videos. So we thank you, and we wish you a healthy and prosperous 2024. And again, I'm looking forward to it. I think it's going to be a year of tremendous volatility, but tremendous opportunity. So we'll talk to you next week, guys.